Joining us now in a CNBC exclusive interview with his first reaction to last week's Fed decision and jobs report is Jeffrey Gundlach. He is the founder, CEO, and CIO of DoubleLine. It is good to see you. Thanks for being here.
Good to be with you again, Scott.
So you now have the benefit, of course, of not only the Fed decision having been made and hearing from the chair, but you have a jobs report to think about in answering my first question, which is, did the Fed make the right move last week by not cutting interest rates?
Well, I think that's up for debate right now. You know, one thing that Jay Powell said, he said, one of the words he used was, we want to be efficient in the way we manipulate the Fed funds rate. I'm not really sure what he meant by that, but he seemed to be relying a lot on the fact that he has two sets of inflation and jobs data that were going to come in between that meeting last Wednesday and the one upcoming. And it was certainly quite a week for data. You know, you had GDP that came out pretty good, and then you had the Fed meeting, and lots of interesting cross currents at the Fed meeting. And then you had that wild jobs report that kind of changed everything. So I'm actually sort of glad that we took a rain check on doing it last week, because you're right, so many things have come in. I thought that Powell was quite hawkish at his press conference. He actually said, in response to one question, in a way, we are looking through the current inflation data. Otherwise, we might have raised rates. I don't think there was a single question at the press conference about raising rates. It was all about cutting rates. And I thought Steve Leisman characterized the meeting very, very well. He said, basically, Jay Powell said, we are at our employment target, and we are not at our inflation target, which I think is a fair characterization by Jay Powell and Steve Leisman characterizing it that way. But then all of a sudden, it looks totally anachronistic, since we had that jobs report with its 100,000 jobs being eliminated or revised away. And so suddenly we have this gap between the Fed funds rate and the two-year Treasury, which widened out dramatically last Friday. It was about a 25 basis point move down in the two-year Treasury. So now we're getting at that strained level again, where the Fed funds rate is 70 basis points higher than the two-year Treasury rate. So the two-year Treasury is looking for a rate cut. This is very reminiscent of exactly 12 months ago when we had the September meeting, and they had to cut rates 50 basis points because they should have cut them, perhaps with the benefit of hindsight, in the July meeting. And that kind of feels like where we are again. It's not as bad as it was a year ago, where the two-year Treasury was over 100 basis points below the funds rate, but 70 is quite a lot by historical standards. And so there is talk in the air of, if indeed there is another weak jobs report or revisions lower, you know, people might be talking about a 50 basis point rate cut. We'll see what happens there. So I feel like this data that is coming out is getting much less reliable, and this has been building for a long time. People are saying that, you know, the surveys that are sent out to be filled out for the jobs report, only 60% are being responded to, and that's been rising over time. Also, the CPI data is getting kind of suspect. Several years back, about 8% of CPI input prices were estimated. They call them imputed prices. Now it's 35%. It's jumped way up. So 35% in the most recent CPI report of the inflation inputs are just kind of made up. And so people are starting to get really worried about the reliability of a lot of this data. So I think it's almost a certainty at this point, unless we get a mirror image of this jobs report for the next one coming out. I think it's virtual certainty that the Fed is going to cut rates. And in fact, now, even though there's not that many meetings left in the year, we're starting to see market pricing of perhaps as many as 3 rate cuts this year. I'm skeptical of that. One thing I've been consistent with all year, starting with the January conversation we had, Scott, is I said I think 2 rate cuts maximum here in 2025. Now, I think that the data has weakened so substantially with these revisions that it's possible that we get a third, but I still think my base case is 2 rate cuts this year. So these revisions are strangely statistically on these, because these job revisions seem to almost always be negative. Biden had 48 jobs reports over four years, and 45 of them were revised lower subsequent to the first release. So some people kind of cynically say maybe they like putting a rosy number on the headline because everyone pays attention to the jobs number on that first Friday of the month, and the revisions usually get a little bit swept under the carpet. These were so big, though, that it was
Right.
kind of like a bomb went off, and the 2-year Treasury yield went way down, 25 basis points. Interestingly, with stocks recouping more than half, well more than half, I think, of their losses from Friday, the 2-year Treasury yield is basically unchanged.
Well,
So that pricing remains intact.
well, because you've always made the argument that the Fed follows the 2-year. And I'm wondering if what we're seeing in the equity market today is stock market investors starting to think that, well, we're going to get rate cuts now. If you can believe in any way, shape, or form that the labor market is going to be weakening, as this data would suggest, then rate cuts are in the offing. So why not buy stocks? I feel like that's where we are today. What do you think?
Well, lower rates are supportive of stocks, obviously, and it kind of takes off some of the pressure for the valuation being so high because you're going to get rate cuts. Well, then the valuation will not look quite as overextended. So it's not surprising at all that the market recouped, because the 2-year yield has not gone back up today. So the mentality of the fixed income market is that the reaction that happened on Friday remains sensible. And so, yes, the probability for rate cuts has clearly gone higher. I still think that the one of the big impacts we're going to have here, though, that we have to watch out for, is the U.S. dollar index has been falling. It's back below 99 again, and it really is amazing that commodity prices can't get any traction with the dollar falling pretty substantially over the course of this year. It kind of suggests that there isn't all that much of an inflation problem. People are focused on these tariffs, and they're worried that they're going to be inflationary. Jay Powell says that it might be a one-time inflation increase. I mean, there's some logic for that, and certainly some parts of the consumer markets. But what really affects inflation is money supply. It's Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon. And so tariffs do not increase the money supply. So it's going to have an uneven effect. Some prices will probably go up, but it'll take demand away from some other places. The money supply, M2, is up 4.5% year over year. It's actually been expanding at an increasing pace, not in an alarming way. And there is some seasonality to it. So typically, as we get around the end of the year, for whatever reason, the money supply tends to level off. But if the money supply keeps growing at 4.5% on a year-over-year basis, I would be worried about the inflation rate not coming down to the extent that the Fed wants to see it, down to 2% or so. But the inflation numbers that I give the most credibility to always are the actual prices, not all of these adjusted things for quality, and if the price of a TV goes down a whole bunch. Yet the quality of the TV is so much better, and so there's this multiplying effects. I think import and export prices, which is a monthly number that comes out that are not seasonally adjusted, are really the best measures of inflation, and they're really not that alarming right now. Import prices are actually slightly negative year over year for the U.S., and export prices are up about 2.7. So if you kind of average those two, we are fairly close to the Fed's target. But Jay Powell spoke a number of times about, well, maybe we should raise rates. I had the impression that he was being just a little pushback. He doesn't want to be, muscled around by politicians and President Trump. And so I think he was a little bit laying it on kind of off the cuff, a little bit thick on what he thought was the potential for higher inflation.
I wonder if we are at somewhat of an inflection point to things that we've spoken about in the past, and I think you are referencing a bit here, the tension between the two mandates. The fact that we now have serious concerns, I suppose, about where the labor market's going from here, but yet inflation by the Fed's metric is above target. So how can they act in that environment? In one way or another, something's going to have to win out. When we were last together, you said of that, quote, at some point, one of these dual mandates is going to have to win out over the other one. And I think, and you've got to pick one, and I think they'll pick fighting the rise in unemployment more than fighting the rise in inflation. Are we at this point where the Fed needs to pick sides after that jobs report?
I felt, yes, I think that's built all year. It's curious that when we started our conversations this year in the January meeting, Chair Powell was more relaxed and more confident than he'd been in quite a long time. He was talking about how our policy's in a really good place, we can wait and see. And as the year has gone along, the tension has continued to build. And it really hit a crescendo last week with, obviously the Fed saying we don't want to cut too soon, we'll risk an inflation problem. If we wait too long, we'll risk a labor problem. Then all of a sudden you had that bombshell of an employment report. And so now the tension is at a local high for sure. And I think that tension could very well grow. So if the unemployment rate continues to rise or rises further above its 36-month moving average, 3-year moving average, and it's well above it right now, and also the 2s10s yield curve versus its 12-month moving average looks full-on recessionary by historical standards. You just take a look at the yield difference between the 2-year and the 10-year and map it against its 12-month moving average, and it looks exactly like it did right at the front edge of the last 3-4 recessions. So I'm going to be watching that very, very closely. So the Fed really is going to have to pick a mandate, which side of the mandate. And I believe that really, when push comes to shove, rising unemployment, should it take hold in a more aggressive way, will almost always win out over the inflation side of the mandate, because that's right where people live. If jobs are disappearing, then there's a demand by the populace for some sort of action that will relieve the situation. And the inflation numbers, I think a small increase in the inflation rate could be blamed on tariffs, whether it's tariff driven or money supply growing, doesn't really matter. If it goes up, you can blame it on tariffs and then hope, as Jay Powell has articulated, there will be a sort of a one-time deal. Well, that would just be, go ahead.
Well, that speaks to the dissents that we got, right, from Bowman and Waller, where Waller says you're being, overly cautious if you don't cut now. And Bowman said, well, we should be looking through exactly what you're talking about, these one-time price increases, rather than thinking they're going to be something more protracted. I'm wondering what you thought of not only the dissents themselves, but who they came from. It's not insignificant in any way that they came from two Fed governors. And we haven't seen anything like that in some 3 decades. So they hold more weight, if you will. What do you think?
Well, yeah, maybe one of them wants to replace Powell as Fed chair come the end of his term coming up in May. So we also had there's going to be another Trump's going to have another nominee to go on there. So you're going to go to 3 dissents almost certainly. And after this employment report, I'd say that if they don't cut rates, if you get anything resembling this employment report again, I think there's going to be many dissents. So we're really, you're right. There's a little bit of turmoil going on between Trump's rhetoric and his sort of veiled threats and these dissents happening. Things are sort of changing direction from what we might have thought was normalcy. I mean, all these, earlier on, I talked about how the data quality is deteriorating, and both the CPI and clearly these revisions on employment. It's strange that the revision, the 253,000 or whatever is 258,000 revision, almost half of it was from government workers. I mean, does the government not even know how many government workers there are? It seems embarrassing, quite frankly. Now, you could say that maybe there actually were some cuts from Doge. I don't know if that's true or not, but if that could have some sort of an effect on it. But it is strange that the government can't really accurately calculate how many government jobs there are on a timely basis. You have to revise them to a very large extent months later. This is a lot of things have to be tightened up here. I remember when the Doge thing was going on, when Musk was still working on it, they were saying they couldn't believe what terrible technology is embedded in a lot of these government offices, where they're like using ancient technology. I mean, they might be using floppy disks for all I know. This needs to be upgraded. Unfortunately, we've been spending money on things that don't increase the efficiency of the data or the reliability of the data. Instead, we're spending money on, we're just borrowing money like crazy. We're still running a deficit. We're on track for this calendar year to have a deficit that's almost 7% of GDP. And if this economy is weakening and if jobs are weakening, that's going to be a further problem in terms of the long end of the Treasury market. I've been negative on the long end versus the shorter end of the Treasury market. We had a huge move yesterday. And now we're out to between two-year and the 30-year, we're out to about 110 basis points. And this just keeps on going. And I think that's very likely to continue, given the fact that the president clearly wants a Fed chairman that's going to cut rates, and they want to finance the debt. There's very little that's financed on the 30-year. It's less than 2% of all issuance. But there's a fair amount that's on T-bills, and the 2 years roll over with regularity. It doesn't take long for 2 years to go by, and we have a situation where there might be collapsing interest rates with a much more dovish Fed chair come 2026. At the same time, as we have a very high deficit, which is really a strange situation for who's going to finance the 30-year Treasury bonds and the 20-year Treasury bonds. We have been avoiding, even incrementally further avoiding, a few weeks ago, the long end of the Treasury curve. I still think that's the way to go. It is interesting that
to avoid
since
it.
the Fed,
I just want to make that clear, because you have made the argument with me to avoid the long end of the curve. You like the shorter end, the belly of the curve, and you still want to avoid the long end.
Oh yes, I mean the trend it just keeps. It almost never flattens. I mean, it did, I think, in the month of July a little bit, but really, it's a trend. I've seen 2s 30s be 150 basis points many times. I would be quite. I'm quite strong on the idea that the 2s 30s will go to 150 basis points, and we're at 110. So we've had very bad performance from the long end of the bond market, even since the Fed started last September cutting rates. The rates are down 100 basis points. And typically, when the Fed cuts rates, all maturities go to lower yields. But the long end is still significantly higher in yield than when the Fed started cutting interest rates. This is really the first time that has ever happened. And a lot of things are acting differently than they used to. I've pointed out there have been 13 corrections in the S&P 500 since around 2010 or so. And the first 12 of those corrections, drops of more than 10% in the S&P 500, all time, the first 12 of those times, the dollar went up when the S&P corrected. This time, when we had the trouble back in March, April, the S&P went into a correction, and yet the dollar went down by about 8%. Usually it goes up by about 8% when you have corrections in the S&P. This hasn't happened ever before this cycle, at least in modern times. And so a lot of things aren't behaving the way they used to. And I would echo back what you said, Scott, just a few minutes ago, that these dissents by governors is fairly unprecedented as well. Mm-hmm. So things continue to, the old systems, the old data systems, the old protocols seem to be weakening, if not reversing. in many ways. And I think that one of the reasons for all this is I think secularly the dollar is headed lower, and maybe a lot lower. We're right on a trend line that goes back to about 2010, maybe the late 00s, where we are right. We're sitting, if you look at the Dixie index, you just draw a trend line. There are two lows that connect, the line connects, and where we are right now is right on that line. So if the Dixie index weakens further, and that's likely if the Fed is cutting rates while Europe and Japan are not cutting rates, well, we'll break through that trend line and we could go much lower. And that's not good for the long end of the bond market either. It's very helpful to finance your debt when you have a strong currency, when people are interested in buying your debt and you have a strong currency, but that's not the case right now. What foreign investor wants to buy into the dollar bond market if the dollar is depreciating? The currency translation is just a capital loss for them. So I pointed out that since the past 18 years or so, we've had about $25 trillion flow into U.S. markets. The net U.S. position was $3 trillion, and it got up to 28 trillion, and now it's reversing. So it looks like money is not really coming into the United States the way it used to. And when you're threatening tariffs and other punitive actions on trading partners, they're probably disinclined to increase their purchases of your debt, particularly at the long. And I think this is a sort of fundamental problem. So yes, avoiding the long end of the Treasury market and investing in 5 years, 3 years in the Treasury market is good. The 2 years is getting less and less interesting because the yield is down to 370 or so, and it used to be quite a lot higher than that. But it started out anticipating Fed cutting rates, and the Fed did that twice, 50 basis points each. But now the 2 years is strongly signaling that bond investors think that the Fed should be cutting rates.
All right.
And so that's what we're looking for. And we one last thing, credit spreads have been volatile this year. It's my dog, let him out. Credit spreads have been volatile this year, but point to point, they've hardly changed at all. Incremental yield for credit is quite low. We're right back to where we were starting the year. We had a lot of volatility. Spreads widened by 200 basis points on emerging market debt and on junk debt. And yeah, junk bonds widened out on Friday, but by 25 basis points, that's a lot in a day, but they're still pretty tight. So we're about 300 basis point OAS on high yield bonds, and it never goes inside of about 250. It did get there at the tights of the year, but now we're back to where we started the year, pretty much on all sectors of the bond market. So the strategy has been kind of unchanged for much of this year with not a lot of point-to-point volatility. But the types of things I talked about in the past is still central to our playbook, and it's been working quite well.
Jeffrey, let's take a quick break. I don't want you to go anywhere yet. We'll do that, and I'll come back. I got more for you on the other side with Jeffrey Gundlach of DoubleLine. You're watching Closing Bell on CNBC. We're back with our Closing Bell exclusive, our interview with DoubleLine's Jeffrey Gundlach. Jeffrey, lastly on Chair Powell, before I talk to you about some more investment ideas, there are those who make the argument that Powell should resign now to actually preserve the independence of the Fed, that he's in a no-win situation, in a sense, at this point. If things work out great, the president takes all the credit, and if things work out poorly, Powell gets all the blame. Should he serve out his term, or should he resign?
I think he should serve out his term. I don't think him resigning says much about Fed independence. It suggests to me that he's being browbeaten. And, yes, you're right that Trump will take credit for everything good that happens and will blame other people, and in this case, Jay Powell, for everything bad that happens. But I just don't think it's a good idea for Fed chair people to resign. I think they should serve out their term, and he should do that. I think if Powell resigned, it's pretty obvious that we'd get a rate cut very, very quickly, because that somebody that is rate cut oriented is going to be installed. And I feel that that's it's just a question of when that happens. when Powell gets replaced, whether he resigns or whether he just serves out his term, he's going to be replaced with somebody very dovish. And that, I think, is very negative for the U.S. dollar. And I think it's very negative for the long-term bonds. Again, all these trends just seem to be very firmly in place to me, that the long end of the bond market cannot rally very much. It's interesting, we've seen the 2-year Treasury come down a lot, leading the Fed on, but we're not terribly far away from the high of the year on the 30-year Treasury bond. And I say the same thing, I make the same similar comment in a different way about gold, something that I've been bullish on. Gold just doesn't go down. I mean, yeah, it got up there briefly to a high number, but it just doesn't sell off. It just keeps sitting there at $3,300, $3,400 an ounce. And one thing I've learned after all these years in this business is when something moves a long way and it just consolidates and doesn't fall and yet has sometimes some good reasons for showing bigger correction. Gold hasn't corrected hardly at all. I mean, if you're long gold, you haven't had anything to worry about. I mean, sure, there's volatility day to day, but the level has held up. It's doubled in price over the past couple of years, and it doesn't show any signs of relaxing. So I feel like these things are long-term trends that have started to develop, and I'm sticking with them until such time as there's some fundamental reason on the horizon why these things are going to change. But if the economy is weakening, we're going to have more bond issuance from the U.S. government as tax receipts would go down and expenditures would go up, and we're starting at nearly 7% of GDP. So we could easily see a budget deficit that's $3 trillion, $4 trillion in the next recession. And that's not going to be good for long-term bonds. So I am sticking to my ideas that I've been developing over the past few years now, that in the next recession, you are not going to see a long-term government bond rally in the United States. I thought you'd see one initially on a knee-jerk basis, and that indeed happened. But now we're closer to the high of the year on yields than we are on the low of the year. And this in the context of a weakening picture in many parts of the economy, and most notably now, perhaps one robin doesn't make a spring, but perhaps this employment report last Friday is more meaningful than we thought it was going to be on Thursday evening. So we'll see what happens. I think employment is clearly weakening. The establishment survey is the one that comes on the first Friday of the month. There's also a broader survey, a household survey. The jobs created in the household survey are negative for the last 3 months cumulatively and the last 6 months cumulatively. There's negative job growth from the household survey. And so it's pretty clear that the labor market is we always say it's a lagging indicator. It's not a leading indicator, it's a lagging indicator, and it appears that it's starting to fall in line with some of these other indicators which have been suggesting weakness for quite some time. So that's where I think we are, and I think we're going to see the Fed cut rates at least a couple of times, probably 2, maybe 3 this year.
So it's somewhat of a conundrum for investors. If you think the economy's weakening, you're like, well, maybe I don't want to own U.S. stocks at current valuations. However, as we already discussed, if the Fed's cutting, well, I don't want to fight the Fed because that would be silly. So I might as well buy stocks. But you've been favoring non-U.S. equities, Europe, Mexico, India. Yeah. Do you still, and how does that factor into what even you admit is going to be a rate-cutting environment? The only question being how many?
Yeah, these ideas are long-term plays. I particularly when it goes to risk assets, equities for sure, I take a very long view. Most people, that watch CNBC, they're watching the markets minute by minute, certainly day by day. And they may be making adjustments week by week. I don't invest that way for long-term money, for risk assets, which is long-term money for me. And I think that these non-U.S. trends are absolutely wrapped up and in place because the dollar is weakening. and it's going to continue to weaken as the Fed cuts rates and other countries don't. So I think as a dollar-based investor, you're making money on the currency translation, and depending on what day you look at it, you're having similar types of gains on just an absolute percentage basis. But when you translate it into the dollar, you're doing much better in some of these other places than you are in the U.S., unless you're in the momentum stuff in the United States, which is just continues to set new highs. I am just not a momentum investor. I'm much more a value investor. It probably comes from my heritage of being, growing up in the fixed income markets, where us bond guys, our job is to find 10 risks when there's only 3 risks. We're trained to be. It's a negative science. You're trying to avoid risky things, because in bonds you make money slowly and you lose money quickly if you get into a default cycle. Equities, I've been investing in India for years and years, and I just believe that the 20-year outlook there is very, very strong. And I'm a dollar bear, so I think foreign markets for dollar-based investors make a lot of sense.
Okay, we'll leave it there, and we will see you next Fed Day. And we will see you in person, too, at your headquarters in L.A., which I look very much forward to. Jeffrey, be well. We'll see you soon.
All right. Good luck, everybody.